You ever notice how one tiny thing can mess up your whole day? You miss your morning alarm, you hit traffic, you show up late, and suddenly everything's off. That's the butterfly effect. Small flap, big impact. And right now, the global economy is having one of those moments. Maybe you felt it lately. The punch at the gas pump. That sinking feeling when you open your student loan portal. The mini heart attack when your crypto app flashes red. It feels like we're all strapped into a roller coaster controlled by decisions we don't get to vote on. From the Fed, to the Treasury, to the policy debates happening behind closed doors. But here's the plot twist. The biggest threat to your wallet this year isn't coming from Washington or Wall Street, it's coming from Tokyo. A single number, 3.41%, the yield on a 30-year Japanese government bond. But beneath all the noise, something far quieter is taking shape. Something most people haven't even noticed. Just quietly shook the global system. No headlines, no alarms. But if you know how these things work, that tiny ripple overseas can turn into a financial hurricane right where you live. This isn't some abstract, wonky metric. That number could hit your mortgage rate, your investment portfolio, your car loan, even your precious Bitcoin. So let's break down how a subtle shift in Japan can ripple directly into the prices, loans, and investments you deal with every day. The free money party is over. For almost 30 years, Japan has basically been the world's chillest friend, the guy who always picks up the tab, never asks you to pay him back, and somehow still shows up with snacks. That's what their zero-interest policy was. Japan effectively became a source of ultra-cheap capital the world quietly depended on. Here's how the trick worked. Hedge funds, banks, even big trading desks borrowed yen for almost nothing. Then they flipped it into dollars and shoved that cash into anything with a pulse. Tech stocks, global real estate, high-growth startups, even early-cycle crypto positions. Back when it felt like the Wild West. That cheap yen wasn't just extra money. It was the jet fuel behind one of the longest bull markets any of us have ever lived through. But here's the plot twist nobody expected. The friend finally checked his bank balance, and for the first time in decades, Japan realized the cost of keeping money artificially cheap was starting to outweigh the benefits. They're not laughing anymore. The Bank of Japan is letting interest rates rise for the first time in decades. No more free refills. No more bottomless loans. When the cost of borrowing yen goes up, the entire carry trade machine starts grinding. Suddenly, the math doesn't work. All those global investors who relied on Japan's near-zero rates are realizing the party's last call wasn't symbolic. It was the real thing. And when the free money gig ends, the hangover doesn't stay in Tokyo. It hits New York, London, Berlin, and your investment apps. Japan's impossible choice. A real-life Game of Thrones. So why did Japan suddenly slam the brakes on a system they kept alive for decades? Because they're stuck in one of those brutal Game of Thrones situations where every move is a losing move. No matter what they choose, somebody gets burned. Think of it like a strategy game where Japan is surrounded on all sides, low on resources, and the clock is ticking. Path 1. Fight the inflation dragon. They raise interest rates to defend the yen and keep prices under control. Sounds heroic, right? Slay the dragon, save the village. But here's the twist. Japan is sitting on a mountain of debt, about 230% of their entire economy. When rates rise, the cost of maintaining that debt explodes. It's the economic equivalent of trading short-term control for long-term vulnerability. Sure, you might win the battle, but you might also bankrupt the entire kingdom in the process. Path 2. Protect the currency wall. If they keep rates low, they avoid the debt bomb, but then the yen keeps dropping. A weaker yen makes imports insanely expensive. Imagine paying double for groceries, electricity, or gas. That's what Japanese households are dealing with. A falling currency chips away at people's savings, trust, and patience. That's how unrest starts. That's how governments fall. And then there's the wild card, China. Increased military pressure in the region has forced Japan to double its defense spending, money they absolutely do not have. It's like another faction marching toward your borders while your economy is already bleeding. You can't ignore it, but you can't afford it either. Japan isn't choosing between good and bad. They're choosing between a recession, a debt crisis, a currency meltdown, or a geopolitical nightmare. And whichever path they take, the shockwaves don't stay in Asia. They hit every market connected to the yen, which means us. The Great Unwind, how the dominoes fall on Main Street. So, the yen carry trade is unwinding. Cool headline. But what does that actually look like for someone living in Ohio, Texas, Florida, or anywhere on Main Street? Here's the truth. This isn't some distant financial drama. This is the world's biggest margin call, and you're in the splash zone. For years, hedge funds and big institutions borrowed yen for practically nothing, flipped it into dollars, and rode the American bull market like a theme park ride. But now that Japan is raising rates, those same players have to pay that yen back, fast. And when big money needs cash fast, they sell whatever they can sell now. So what goes first? The stuff young investors love: liquid, high-value assets. High-volatility assets take the first hit. Tech stocks, crypto positions, and emerging market plays are usually the quickest to be sold off from the bottom of the tower. This isn't a correction. This is a global fire sale. But the part that hits hardest isn't the markets. It's your everyday life, and that's where the consequences stop being theoretical. When Japan turns off the free money faucet, global borrowing costs rise across the board. Suddenly, that 7% mortgage rate you've been complaining about starts looking normal. Car loans, student loan refinancing, small business loans, they all climb. Even your credit card APR, already painful, inches up because the worldwide cost of capital is shifting. If you're trying to buy a home or finance a car, the cost rises. Not suddenly, but steadily and unmistakably. Trying to build an emergency fund while inflation is still chewing up your paycheck? Harder than ever. For an entire generation that grew up on cheap money, low rates, easy credit, fast gains, this is a wake-up call. The cheap money era wasn't just a financial backdrop, it shaped your adulthood. And now it's disappearing in real time. This is what global economics looks like when it hits the street you actually live on. The end game and what to watch. Now that we know the pressure points, the real question is how to recognize the next major shift before it happens. So, is this the financial apocalypse? No. Think of it more like a great reset, an end to the fantasy era where money was basically free and everything kept going up just because. We're stepping back into reality, and instead of panicking, this is your chance to actually understand the game board. So here's your cheat sheet. Simple signals you can track yourself without needing a PhD or a Bloomberg terminal. Signal number 1, the yen, USD JPY. This is the heartbeat of the whole situation. If the yen strengthens sharply, especially below 152, that's not a routine move. It's a signal that major positions are being unwound. It means the carry trade stops being profitable, and big institutions may start unwinding positions at scale. Think volatility, sell-offs, spikes in fear indexes, liquidity crunches across global markets. Signal number 2, the BOJ's announcements. You don't need to watch the full press conference, just know when they happen. Circle December 18th to 19 and stay tuned for every rate hint they drop. A single sentence from the BOJ governor can shift billions across global markets in seconds. Signal number 3, U.S. intervention. Watch for clues that the Federal Reserve might step in to stabilize the yen. A currency swap line, backroom coordination, or surprise statements from Treasury. These are the tells that Washington is worried. It would be like pulling the emergency brake on a train that's already skidding. Here's the bottom line. The hidden engine that powered the world for 30 years is sputtering. The Tina mindset, there is no alternative, no longer holds up. Cash isn't trash anymore. Assets with actual profits, real cash flows, and fewer hype stories behind them will dominate the next chapter. The game isn't ending. The rules are just changing, and you can be ahead of it. So no, the world isn't ending. But the assumptions many of us relied on, low rates, easy credit, steady markets, no longer apply. The days when you could just toss money into any hype stock and hope it moons are over. Now it's about being intentional, being aware, and actually understanding how a bond trader in Tokyo can change the price of your next mortgage. This isn't a Japan problem. This is a global reset of how money moves, how markets behave, and how risk actually feels. And in moments like this, information becomes your superpower. Not fear, not panic, awareness. That's your edge. Because the people who adapt first, the ones who pay attention, diversify, and think long-term, are the ones who come out stronger on the other side of resets like this. So stay sharp, stay curious. And if you want to stay ahead of a world that's shifting fast, keep paying attention. Awareness has always been the real advantage.